Buenos días a todos. Simplemente en 2 minutos daros la bienvenida a la que hasta hace poco era nuestra casa. Sabéis que este hotel forma parte del ecosistema de Edmond de Rothschild. Ha sido comprado, rehabilitado y puesto un poco en explotación por parte de nuestros fondos de private equity de Rothschild. Daros la bienvenida, daros las gracias. No voy a volver a insistir en lo que todo el mundo está comentando, que vaya año horrible. Ya lo sabemos, quedan 2 semanas, con lo cual ya está hecho. Simplemente deciros que vamos a daros un poco las líneas de las claves de inversión por parte de nuestro CEO, Melman, que nos va a hablar un poco de pues dónde vemos el mercado el año que viene y sobre todo viendo un poco el vaso medio lleno después de este año complicado. Donde vemos las oportunidades, porque al final a río revuelto ganancia de pescadores, con lo cual no me voy a extender más. Dar las gracias a todo el equipo de Edmond de Rothschild en España, Federico, Joaquín, Pepe, Jaime y Sebastián, que os hablará luego al final. Y Benjamin, the floor is yours.
Thank you, Maria. Good morning. So, is the sound okay? Can you hear me? Hein? Je pose. Okay. So it's good to see you again in Madrid, and I'm very happy to discuss about our market outlook, the way we see market going in 23, knowing that we had a lot of surprise, to be honest, to be fair, in 22, and we are very happy to close this very, very, very difficult year. Just before talking about the future, I would like to discuss just 2 minutes about this year and the past, and the fact that we had a very, very specific year, because you can see here for many decades the return of equities, fixed income, and as we know, sometimes we have deep negative returns on equities. No surprise, it happens, but it almost never happens to have deep negative returns in equities and in fixed income. Actually, if you dig further and you see what happened during the 70s, the only period when such things happen is when there is a burst of inflation and central banks start to chase inflation with a rebound of the real rates. And to be honest, it's exactly what happened this year. We know that inflation started not in 22 but in 21. Central banks have been lagging. They react lately, but very forcefully, and we had to pay the impact of the market. So if only we knew that we would have such a level of inflation, all the surprise we felt this year wouldn't be a surprise, but we had only to keep in mind what happened during the 70s. So what is this graph is telling us about the future? We clearly see that the good thing is that inflation is a steamroller. So inflation is devastating the economy, but it is also devastating all the markets, the market performance. But the thing is that disinflation too is a steamroller. If you look at the beautiful years here on this graph, with positive return on equities, with positive return on fixed income, it's almost when disinflation happened. So if inflation has a strong impact on the market, disinflation too. And we know that it's all the topic of the moment, disinflation. We had the US CPI yesterday, and again for the second month we had a falling CPI, a slowing US inflation below expectations. Now we will see what happened on European inflation. But to be fair, disinflation has started. So do we believe in disinflation? Very clearly, yes, we do. If you listen to our economists, they forecast 2 years of disinflation, and they forecast that inflation should come back to 3% in the US by the end of 24, 2.5% in Europe. So, but we don't know if it's going to be a straight line. I used to be an economist. I'm not an economist anymore. I'm a market participant. And as a market participant, I always take with a pinch of salt any forecast on inflation, because inflation is a topic everyone gets wrong. And so you have to be very, very wary about any inflation forecast. But even if you are suspicious about any... Thank you very much. Even if... Oh, wow. Even if you are suspicious on any inflation forecast, it's true that the best educated guess is that the US inflation is going to slow down in 23. Why? We know that we have had a falling commodity prices, falling freight prices, normalizing supply chains, and also inventories which are being cut because inventories were massive at the beginning of 22. So all this is dampening the good prices. Good prices are already falling, but it should continue for some months. And what do we know also? So let's say the first semester, inflation will be dampened by the good price. But we also know that thanks to the real estate price collapse in the US, rents are going to slow down in the US during the second semester. That's what all the model will tell you about the lags between the rent price and the real estate price. So you have a pattern. The first semester will be dampened by the good price, and the second semester will be dampened by the rents in the US. Let's keep in mind that rents is a third of the US CPI, so it's massive, it's very important. The big difference between US and Europe is the fact that in the US, you have got the rents. In the Europe, it's still not in the index. So the rents is having a huge importance in the US inflation. And we know that for the market, it's not the European inflation which matters, it's the US. So whatever the kind of confidence you can have in any forecast on inflation, and to be honest, I'm very suspicious to any forecast on inflation, but at the end of the day, the best educated guess you can have is that at least inflation is going to slow down in the US for 23. So is it a 1 year or a 2 year pattern? What is very true is that you are not going to get rid of inflation as long as the labor market keeps as tight as it is. Wages are rising above 5%, which is meaning that the underlying inflation of the wages is 4%. We would be very happy today to have a 4% inflation in the US. It's still far higher. But nevertheless, what will be very important is that wages start to slow in the US, and the labor market tensions have to ease. When is it going to happen? Well, we need a recession in the US for the wages to slow. The fact is that we expect a US recession and a European one next year. Not a strong one, but a recession. And then we will measure the impact the US recession will have on wages. We can hope that the recession will slow down enough the wages to make sure that inflation will come back toward the famous 2%, which is the main central bank's target. So what are we saying here is that we have to keep in mind that inflation as disinflation is a streamwaller for the market. At least you will have 1 year of disinflation in the US for all the reasons we mentioned. That's the best educated guess we have. The only thing we'll have to make sure is that by the end of 23, so we have almost 1 year, and we know that 1 year with the market is almost an eternity, where wages start to slow in the US, and we think it should slow thanks to the recession we expect. So you are going to tell me we could wonder about this US recession, which is never coming. For months, everyone has been talking about recession, the US recession. And if you look at the latest Atlanta Fed nowcast, Q4 growth in the US should be above 3%, which is amazing when you are waiting for the recession. The thing is that the recession is not coming. Why the recession is not coming? It can be weird to say that, but the current disinflation is boosting purchasing power. Goods are less expensive, and therefore the current disinflation is very supportive for growth, postponing the recession. And that's why everyone is delaying this recession, which is mandatory if we want to make sure that we are getting rid of inflation. So what the irony here is to highlight the fact that this disinflation is not helping the real disinflation, the fact that the wages are tamed. But it's not because the US recession is postponed that it's not going to happen. Profit margins are getting squeezed on the corporate side. Banks lending standards are getting tightened by banks. And we know that when corporates face more difficulties with their profit margins, they tend to cut capex, capital spending. They tend to reduce their workforce. And that's the way a recession starts. A recession almost always starts when corporates want to restore their profit margins. Profit margins have already been reduced somewhat, not by much, but we think that in the coming months, they will start all the procedures in order to restore their profit margins, and that will be the trigger of the recession. Do we have to fear a strong recession? We do not think so, because this time, all the private balance sheet, not the public ones, unfortunately, but the private balance sheet are very solid. It's true for the households. It's true for the corporates. It's more than true for all the financial sector. Very, very sane balance sheet. And therefore, what makes the big difference between a soft recession and a harder one is all the restructuring of the balance sheet. Not needed this time. Not needed because the balance sheets are quite strong in the private sector. That's why we think the recession in the US, but also in Europe, will be shallow. So what is the Fed going to do in such an environment? Well, we think that Fed will continue to hike interest rate, maybe a little bit higher than what the markets are expecting nowadays. This graphic has been done before the latest CPI and the latest data we are having. Now, if you look at the Fed fund futures, which is what you are seeing on this graph, the market are pricing a Fed a little bit below 5%. And we think that the Fed could go up to 5.25. It's not a big deal, 25 BPs, when you look at all the changes which had to be done during the year. But what is a little bit more surprising is the fact that the market is starting to price some rate cuts by H2. What is worrying us is that the market is not listening to what the Fed is saying. The Fed is very clear on the fact that they need to lead a tight monetary policy, so the tight monetary policy, according to James Bullard, who is the president of the St. Louis Fed, is saying that a tight monetary policy in this current environment is between 5 and 7%. And he prefers 5 than 7, but instead of having 7 for 5, the trade-off is the fact that the Fed will have to keep longer the kind of levels, the kind of tight level of Fed funds. And when they say longer, we guess it's something like 1 year. And therefore, it's very premature to imagine the fact that the Fed will cut its monetary policy during H2. So we have some disagreements with the market consensus today. We think that probably the Fed will be a little bit tighter than what the market expects. It's not a big deal. Rates are going to stay longer than at a higher level than what is expected. Is it a big deal for the market? We don't think so. Is it neutral? We don't think so. It's a little bit slightly bearish for fixed income. We don't think that in the coming months, rates will have a lot of room of maneuver to continue to fall due to the fact that the market seems to have overreacted to the good CPI and on the fact that the Fed will turn immediately dovish thanks to too good CPI, which is not going to be the case. And what can be a little bit more bearish for the equity market is the fact that if we are having the recession next year, as we think, and if the Fed doesn't ease its monetary policy during the recession, it's never good to not having the Fed support in a recession. So we are having a very positive factor for the market, which is the disinflation. Positive for equities, positive, of course, for fixed income. What is negative is that we are foreseeing a recession, which is negative for the risky assets, for equities, and for the deep high yield. Another thing which is important for the market and seems to have been completely forgotten is the fact that we are living in a very poor liquidity environment, and it's going to be worse going forward. We know that the Fed is shrinking at a very strong pace its balance sheet, and you can see M2 growth falling dramatically. So it's a little bit dangerous in that kind of environment, because it's not only the Fed which is shrinking its balance sheet, it's also the ECB. And if you look at the ECB balance sheet in November, there has been a lot of TLTRO reimbursement, and the ECB balance sheet has fallen also dramatically, and it should continue into that direction. Keep in mind that in Q4 18, we had an equity market crash, minus 20% on the S&P 500, not due to fundamental reasons, but due to liquidity reasons. At that time, the Fed was shrinking at a strong pace its balance sheet. We know there is a link between central bank liquidity and market. The thing is that it's very difficult to explain how it works, and I've tried to dig this topic with our financial engineering. I've tried to find some research, and I found a Kansas Fed City paper on this, and they explain that it's very difficult to explain to show the link between central bank liquidity and financial conditions and the market. But it's not because it's difficult that this link doesn't exist. And that's why we have to keep in mind that this very poor central bank liquidity can have a negative impact on the market. It's not telling us that we are going to have a market crash, but if you have suddenly a market crash and you wonder what is happening, don't spend a lot of time to dig. It will be the kind of liquidity. So before going to the conclusion, I would like also to discuss about the other liquidity, the market liquidity. The market liquidity is another concept than the central bank liquidity. Of course, there are links between the two liquidities, but the market liquidity is also very poor. Here you can see our liquidity indicator on the S&P 500. So we try to estimate if the liquidity on the S&P 500 is good or not good. And it's very low. It's almost as low as it was during March 20, where the markets were panicking about the COVID. So it is meaning that few buyers or few sellers can move easily the most liquid market in the world, the S&P 500. So what is going to change is the fact that liquidity, this year inflation was the main volatility driver. We think that next year liquidity could be the surprise, and we don't exclude, and we can imagine easily that we'll have volatility due to the very poor liquidity conditions. And that's why in our asset allocation, when the implied volatility prices will fall, will try to take advantage of this situation in order to buy some protections, because that's typically the kind of environment where you can have a lot of unforeseen events, the kind of thing it's very difficult to forecast, but having a significant impact on the market. So we have to keep that in mind. Talking about implied volatility, you can see here the MOVE index with the implied volatility of the US fixed income market. And here, the famous VIX index, the implied volatility of the S&P 500. What is very striking is that, let's say that implied volatility, let's rename implied volatility the sums of all the fear, that the price you are ready to pay in order to protect your portfolio. So today it's fascinating to see that the sum of all the fears is on fixed income, not on the equity. But that's weird, because the disinflation trend has already started, which should reduce the fixed income volatility. Meanwhile, we are getting closer and closer to a recession, and the VIX index is as low as it was at the end of last year, where no recession was, of course, at the horizon. So in our view, this graph is very showing where the opportunity is. Investors have been shaken by the fixed income market and are still very wary of the fixed income market. If you look at the flows, yes, that's true. In the latest weeks, the US investors came back in their fixed income market and almost offset all the outflows we had during the year. But it's in Europe, not at all. In Europe, flows have been, there is still a high level of outflows for this year, and we have seen some inflows in the recent weeks, but it has been quite low. So as inflation is a streamroller and disinflation is a streamroller, we want to take advantage about the low positioning, the fears that are still in the fixed income market, to overweight fixed income investment in our portfolio. And we will reassess where inflation is going by the end of next year, during H2, to see where wages, to see if really this theme of disinflation will continue for the coming months, for 24 and all this. But today, we have to take, actually, in my view, there is no choice to do this when we rethink again in our investment. There is no choice to step in, to follow the trend of disinflation, and to take advantage of the fact that investors didn't come back on the fixed income market in this kind of environment. And concerning equities, well, on the one hand, disinflation is very positive for multiples, so it's a positive for equities. On the other hand, the recession for next year is not fully priced, and so it will be very bad for the earnings. We don't see strong directional pattern on equities. We are not pessimistic, we are not optimistic. To be honest, we are neutral on equities, as we say, and so no overweight, no strong underweight. Our focus is on the fixed income. Anyway, there are many things to do on the equity market, but let's see first what we can do on the fixed income market. On the fixed income market, if you look at our spreads, the spreads where we stand in terms of spread in the US high yield, European high yield, we tried to see in the past what was the average of 12 months return when you had such level of spreads. And what you can see is that one can hope returns on the fixed income market between 5 and 10%, which is equity-like returns when we think again about it. If you look at, for instance, just investment grade, European investment grade, you look at the Bloomberg European investment grade index, the implied yield of this index is 3.8%, so close to 4%. And if the volatility we discussed on the fixed income start to fall, it's still very high, we know that there is a direct link between fixed income volatility and spreads. Spreads are about, of course, default rate, and for sure, but it's also about volatility of the fixed income market. So when volatility falls, even if the default rate remains the same, the expected default rate remains the same, spreads need to tighten, will tighten, should tighten. That's why we think that we will have next year on fixed income the yield, the return, and moreover, there could be some capital gains, even if we don't expect much fall in terms of yields on the main rate market. So, to sum up, we are overweight fixed income, and we think that next year is going to be a fixed income year, not an equity one. Concerning the equity, we are going to wait for the recession because we know that the best entry point on the equity market is a little bit after when the recession has started. So you don't have to wait the end of the recession, but step in when the recession has started. When will it start? We don't know yet. But still, on the fixed income market, we want to invest in all the main fixed income market having rather good ratings. So investment grade, of course. Financial debt is fantastic because we know that the financial institutions are taking advantage of the higher level of yields, of the hiking ECB rates, and because it is improving very significantly the net interest margins of the banks. So we clearly, banks are in a very solid position, and we want to be overweight financial debt. Talking about high yield, double B, we will try to avoid below double B. Only we will go below double B on specific names, on specific issuers, only if we have a strong confidence in the kind of issuers. We know that we have to face a recession. Concerning the emerging assets, emerging debt, it's true for emerging debt and emerging equities. We think it's still speculative, but it can make a huge difference. First, investors didn't come back on emerging equities or emerging debt. Secondly, we know that the Fed is going to end by the spring its monetary policy cycle. And now it seems that the dollar has already front-loaded the famous pivot, and therefore the dollar is going to stabilize around the current level. So the bull market on the dollar is over. That's one of our convictions. And the fact that it ended is a positive for emerging debt. Last but not least, China is changed dramatically its economic and sanitary policy in the recent weeks. We know that the zero COVID policy is almost over. They are bringing far more support for the real estate market. So China is going to stabilize its growth and to rebound from the very low point where the Chinese economy is. But it is going to be two headwinds on the emerging assets. So we think that emerging assets could make a huge difference next year. And it's true that volatility has been far higher on emerging debt, emerging equities, but now you have attractive valuations and a better environment to come back in such a things. And that's why we think we have to look, even if it's more speculative, at emerging equities, emerging debt. Our most favored themes on equity, because even if we are neutral on the equity market, we don't find a lot of appeal on the equity. We think that there are many things which can make the difference. So we discussed about emerging equities, Chinese equities, but there are also three themes which are very important. Healthcare is, in our view, the perfect spot for next year. Because we are going to have a recession, we know that the healthcare is a highly defensive sector and still generating a significant structural growth. So for next year, in that kind of environment, you will be ready to more investor will be keener to pay attention to that kind of sector, which are having already attractive valuation. So healthcare is another weight in our asset allocation. Two in-house team we love, we like a lot for very different reason. Big data. So big data, we know that the revolution of big data is marching on. We have had a lot of proof that all the corporates using the big data are gaining market shares, are having an advantage versus their competitors. And we still think that the theme of big data, which has worked very well in the recent years, will continue to work well. And one theme which is very important also in our view is human capital. Why human capital and why now? So we know that all the corporates investing in their workforce, it's not it's a very important investment which is bringing productivity and a competitive advantage to the corporate. It has been shown by a lot of research, a lot of academic research, but the human capital makes a huge difference. What has changed in this current environment? What has changed is the fact that the new generation and all the workforce has a different link with the labor, with we have all heard about the Great Resignation and the fact that many people decide to resign, to change their life. We know that there are new generations which are more difficult to retain for corporates, and that's why we think, and we have some reports showing that corporates will invest more in the training of their workforce, in the good working condition in order to retain their workforce and to attract talents. That's why we also think that this team is having a strong appeal in the current environment. So I guess we are over, and I would be more than happy to leave the floor to Sébastien.
No, don't leave the floor. Thank you, Benjamin. I think I need this micro for the streaming. That's why. Okay, so I will not use this one. Okay, no, bueno, nada. Si tenéis preguntas, seguro que sí. Es el momento, hay que aprovechar. Está aquí.
Okay. Okay. Hello. Thank you for the presentation. Just two quick questions. First one, what's the probability you assign to your scenario, and that it's a soft landing? And then the second one, on emerging debt, would you prefer local currency or hard currency?
Okay. Thank
Thanks.
you. Well, the soft recession, not soft landing, because it's we say recession, it's a very high probability in our view. So maybe we are wrong on that. And what could make things wrong is that if we see oil price booming for geopolitical events or that kind of stuff, it's very difficult to foresee. And we know we are in a fragile environment concerning geopolitics and all the kind of stuff which can have an impact on oil. Nevertheless, otherwise, we are convinced of the fact, so I won't give you subjective numbers, but we are convinced by the fact that it can only be a soft recession, not a hard one. And what gives us certainty is a huge surprise when you pay attention to what is happening to capex, to capital spending of corporates. For instance, everyone has been talking about a recession since the beginning of the year. And if you look at corporate investment, it's only -3%, which usually when you fear a recession, it's -15, -20. And so there is still, despite all this ugly year we had, a lot of confidence on corporates. And it has been a surprise when you look at the EPS. EPS obviously have been far stronger than one could expect in the US, but in Europe too. So there is still a lot of confidence. And if we are top-down people, but if you discuss with bottom-up guys, it's a case when I discuss with the equity portfolio manager. When I say I'm sometimes pessimistic, they think I'm mad because what they hear about the corporate is a strong message of confidence. So we are all fearing the recession, but there is such a split between the top-down world and the bottom-up world. At the end of the day, you have also to incorporate all these elements.
Otra pregunta, Antonio.
My question is about liquidity. This year has to increase the liquidity, but we go to have another question that is maybe money market funds, and maybe this liquidity go to deposit, not to the equity or the fixed income market. How do you see?
Oui, tout à fait. Yes. Well, it's true that when the cash is yielding something, and we forgot that cash could yield something, investors could remain on the cautious side and not invest in the market. But they already made a lot of cash this year, and obviously what we see about the cash levels is already high. So yes, maybe they are not going to reduce a lot their cash, but due to the poor liquidity conditions, we think that even a little could boost and could provide some support on the market. I don't know if I answer your question. And I realized that I forgot to answer your question on our emerging debt. Obviously, both local and hard currencies are finding some appeal. I tend to prefer the hard currency because the hard currency debt suffered more due to the rising dollar. So there is a kind of extra yield due to the strong dollar in the spread. And we think that yes, it's easier. The hard currency debt is easier and more straightforward play than the local debt. But the local debt is also having some appeal.
¿Preguntas? Si no, yo tengo dos. Well, Benjamin, just two questions. So one on I know you talk a lot about disinflation, but let's say that finally, for any reason whatsoever, inflation comes back or whatever.
Yes.
So is it really a good moment to invest in fixed income if there is more inflation and contrary of what the market thinks and so on, there is more rate hikes than expected? First question, I know you have the answer. And second question, I know you are neutral, you spend too much time in Switzerland, but on equity, but tell us a bit more about European equities. At the end of the day, our clients have a lot of European equities in portfolio.
Yes. So you are right, Sebastian, to mention that inflation could come back. And again, any inflation expectation is highly suspicious. So even mine, to be clear, don't trust anyone on inflation. Everyone is getting wrong on inflation. To be fair, to be honest, it's a reality. It's a reality. But now, again, I try to explain all the reasons that even if you don't trust anything, the best educated guess is disinflation. And we know that inflation or disinflation is having a very strong impact on the market. So at the end of the day, you have to take position. Of course, inflation could rebound. And what I said is that if the market could fret during this year about inflation, if wages don't slow down during H2. If wages in the US don't slow down, it's sure that the market is going to rethink again about this disinflation pattern and saying, well, it's only one-off, but with such a high level of wages, inflation is going to rebound for next year. We know that Mr. Powell has said that he wanted to be Paul Volcker. But the thing is that Paul Volcker failed, even Paul Volcker failed once on inflation, and he had to lead two tightening monetary cycle in order to get rid of inflation. So that's obviously, inflation is a wave phenomenon, and so there could be a second burst. But what we are saying is that it will be the market will pay attention to this only by the end of the second semester. So we have months, in our view, and that's our conviction, we are quite relaxed about the topic and just enjoy the trend. And by the second half, we'll have to be a little bit more careful about what is going on the US wages. Yes, on European equities. So who would have said that European equities EPS would have been 18% of growth, which is the case. Suppose we don't have Q4 result, but that should be the case for this year. It's just astonishing after the horrible year we had in Europe. So there has been a lot of support on our European EPS, and the rising dollar has been, of course, a boon for the European EPS. The main problem is that this boon is going to disappear. We don't think that the dollar will fall, but we don't bet anymore on the fact that the dollar will continue to rise. So less support from the dollar on the EPS, less support from the profit margins. In Europe, wages are still in an accelerating process. In the US, wages have stabilized at a high level, but in Europe, it's still accelerating somewhat. So there will be some profit margin squeeze due to the wages acceleration in Europe. Moreover, what we have seen is that, let's say Nestlé, it's amazing. They've increased their price this year by 9%. So they saw that they have a beautiful pricing power, and due to inflation was a very good excuse to hike their price by 9%. Obviously, it was a little bit more than the rise of their input prices. But what we hear now coming from the corporates is that we know that the households had some state support after the COVID crisis, and they were ready to spend this extra money and then to pay more the goods, higher price for Nestlé goods, because they were happy to spend, and it was the end of the COVID crisis. But now, most of the extra money has been spent, and it's getting more and more difficult for the household. So it will be far more difficult for the European corporates to continue to pass the inflation into the price. And therefore, it's going to be a second squeeze on the profit margins. So the environment is not highly positive for the European equities, but it's not negative. What is positive in our view on European equities is the fact that it's a wake up for China. What we are seeing and what we are seeing in the current days is highly important and should trigger a Chinese economic rebound, which of course is going to provide a lot of support for all the corporates embedded in the main European indexes which are exporting a lot to China.
No sé si hay más preguntas. Sí.
Okay, let's imagine there's a recession next year, and you have said that liquidity is very poor. That's not a good combination for credit. Do you think that spreads are already priced in that recession, or because it's bad, would be bad for high yield or even
Yes.
AT1s, COCOs, and so on?
Yes. So thank you for this question. You are right. Even if we are bullish on credit, we can't dismiss the fact that the poor liquidity condition could, at some moment, widen the credit spread. So it's a risk, and that's the kind of risk we are taking, but we are obviously quite conscious about. Why credit spreads are not going stepping into the kind of recession levels? It's because there are two reasons in our view. First, leverage is quite low again, and corporates can easily repay the service of their debt. the debt service, due to the very low level of interest rate we had, is still keeping at a very, very low level. And so investors do not expect a strong rise of corporate default. And moreover, when you look at the refinancial wall profile, the next 2 years, 23 and 24, will be okay. It's 25 which is going to be more complicated because a lot of refinancing will happen. But the fact of having such visibility concerning the refinancial wall is also appeasing the investors about the risk. If we have a shallow and short recession, not kind of deep one, of course, but obviously not sure that default rates are going to rise very significantly. And today, if the energy price stay where they are, I know it's a big if, because it's very difficult we sometimes don't know where they go. There is no reasons to imagine a significant recession in Europe, to be fair.
Más preguntas?
Thank you very much for your presentation. I wanted to ask you, what are the reasons, according to you, for this recent short-term rally that we have seen more in Europe than in the US? And if you think, on the positive side, that the resolution in some way of the crisis between Ukraine and Russia, of the war, a sort of sitting to discuss and stopping the war, could be a strong push for the European equity market, or if you think it's already preceding in some way? Thanks.
All right. Thank you. It's also a very good question. We had a lot of internal discussion about Ukraine, and what has changed in our view is now the profile of the outcome is far more symmetrical than 2 or 3 months ago. 2 or 3 months ago, one could be only pessimistic. There is no solution obvious. What is brand new now is that everyone is talking about negotiation. Everyone, the Russians, the Chinese, the Americans, the Europeans, the Ukrainians, everyone. It's now open. We know that the notion of negotiation is already on the table. It has not started as far as we know, but we can't even exclude that some talks already started concerning the peace talks. So what can we forecast on this? Nothing. It would be only speculation, and we don't want to build an investment case on this, but we just only acknowledge the fact that what has changed is that one could be only bearish on the issue a few months ago, and now it's sideways. It could go better, it could go worse, for sure. And I share the assessment in your question that it could be if we have a negotiation and a solution in the Ukraine war, it will be very bullish for European assets, for sure. But can we make such a forecast? To be honest, it's impossible. That's why we won't make it, but that's also a reason why we want to keep European equities in our portfolio, because there is a potential of good surprise. But I'm not going to say that we foresee a solution to this conflict. It's impossible to say such thing. And on your first question was on the rally. Can it continue? On the
reasons you see behind the rally that we have just...
Yes. So in our view, the reason is very clearly due to the better inflation data. And the fact that rates are falling again and increasing the equity multiples. And moreover, as we said, the beauty of this disinflation movement is that it is postponing the recession. So for the equity market, you lower the risk of recession if you have better multiples. In the short term, it's very bullish. Do we chase this equity rally? We don't. We are not going to buy more equities from now than the ones we are having in the portfolio. We are keeping the equity, but at the eve of a recession, it's very difficult to buy equities now. We would love to wait the start of the recession to step in.
Bueno, creo que llegamos ya al final. ¿Vale? Muchas gracias, Benjamin. Muchas gracias a todos. También estamos aquí para vender nuestras soluciones a todo lo que ha dicho Benjamin. Renta fija, ya sabéis, tenemos nuestro fondo a vencimiento EDR SICAF milésima World 2028. Esencialmente high yield, pero en la parte buena, lo que comentaba Benjamin, donde pensamos que va a haber mucho menos default, por lo cual muy importante. Abierto hasta mayo máximo, fondo a vencimiento. EDR SICAF Financial Bond, nuestro fondo sobre deuda financiera subordinada, lo que comentaba Benjamin, que estamos muy positivos, por lo cual ahí es uno de nuestros fondos más grandes, uno de los más grandes del mercado. Para deuda emergente, EDF Fund Emerging Sovereign, un fondo de govies en emergente y en hard currency. Voy a contestar la pregunta, la teníamos la respuesta. Y el último, renta fija, nuestro flagship EDR Fund Bond Allocation, fondo más grande que tenemos en la casa. Y nada, para navegar en aguas turbias, ¿no? Que las vamos a tener el año que viene, pero es el año de fixed income, claramente, como lo comentó Benjamin. En equity, neutrales, pero aún así tenemos las soluciones a largo plazo, la de salud, EDR Fund Healthcare. Yo creo que es el fondo, bueno, es el más antiguo que tenemos. Hemos empezado a gestionarlo en el 85, creo que es, 86. Ha cambiado el gestor, no os preocupéis, pero en fin, es el fondo, claramente un fondo también grande y que se está comportando muy bien ahora mismo. Human Capital, Idea Fund Human Capital, como comentaba Benjamin también, una de las temáticas que tenemos, un fondo mucho más nuevo. El Big Data, yo creo que lo conocéis todos y que además ha tenido un año fantástico. A ver si terminamos en positivo. Diciembre es un pelín peor, pero terminamos en positivo, creo que será un hito tremendo, ¿no? Pero bueno, ya lo conocéis. Y en equity emergente, el último fondo, EDR Fund Strategic Emerging. Nada, muchísimas gracias a todos. Es un poco raro lo del micro, pero es para el streaming, no se escucha aquí, pero y muchas gracias a los que nos escuchan también en streaming. Desearos a todos una feliz Navidad, por supuesto, y que empecemos el año mejor, ¿no? Un año mejor que nadie pensaba que el 2022 podía ocurrir. Lo que esperamos todos es que no se repita, y eso sí que creemos que no se va a repetir. Nada, muchísimas gracias a todos, feliz Navidad y nos vemos en 2023. Hasta luego.
Thank you very much.
Merci.